Welcome to the deep dive. We take complex topics and break them down for you. Today, we're getting into something really interesting about money. It's this idea that, well, being good with money isn't just about being smart, it's more about how you act. We're digging into Morgan Housel's book, The Psychology of Money. It's full of great stories, really makes you think differently. Our goal here is simple. Pull out the key stuff for you, the listener. Help you make, better, maybe even happier money decisions wherever you're starting from. It's about seeing money in a new way.
Exactly. Because, traditional finance focuses so much on the math, the formulas, spreadsheets. But Housel, he brings it back to the human side, our psychology, our emotions. That's really what drives financial success in the long run. It's the why behind the what.
Okay, so let's jump into that first big idea he has, this idea that, well, people do weird things with money, sure, but maybe nobody's actually crazy. What's he getting at there?
It's quite profound, actually. He's saying that decisions that look totally irrational from the outside, they often make perfect sense to the person making them. It all comes down to their unique background, their experiences growing up, the economy then, what their parents taught them about money. Like, what you've personally lived through feels way more real than something you just read about. He gives this really stark example of a tech executive.
Oh yeah, the guy who helped invent Wi-Fi stuff, flashing cash, throwing gold coins in the ocean,
Yeah.
and then went totally broke, right?
That's the one. And then you compare him to Ronald Reed, the janitor from Vermont. Lived super simply, bought a small house, main hobby was chopping wood, seemed totally unassuming. But when he died, he left over $8 million to his local hospital and library.
Wow. And no big secret, right? No laundry.
Nope. Housel makes that clear.
Yeah.
Just saved what he could, invested steadily in, solid blue chip stocks, and then just waited for decades, like compounding do its thing. It's a huge contrast.
It really is. Makes you think. How can two paths diverge so much? And Housel gives more examples, doesn't he? Like JFK and the Great Depression.
Absolutely. Kennedy apparently admitted he didn't really get the Depression firsthand because his family was wealthy. Actually got richer during that time. He learned about it from books at Harvard. Imagine that perspective versus someone whose family lost everything. Their whole view of risk and money would be worlds apart, wouldn't it?
Yeah, totally.
Housel points out, like people who grew up with high inflation, they tend to invest less in bonds later on. Makes sense, right? They saw value erode.
Or the bond king, Bill Gross. His whole career basically tracked falling interest rates, so he saw bonds as these amazing wealth generators.
Right, while his dad's generation might have seen them as wealth incinerators because of inflation they lived through.
Yeah.
It's all about that personal lens.
Okay, so this helps explain some things that seem, well, odd, like low-income folks spending a lot on lottery tickets.
Yeah, from a purely rational standpoint, the odds are terrible. It seems illogical. But Housel suggests maybe it's not just about math. Maybe they're paying for a dream, buying hope, a chance at the kind of life maybe you already have access to. It's a different perspective.
So getting this no one's crazy idea is pretty powerful then. It helps you maybe judge others less and definitely helps you see your own biases, how your past shapes your views now. And it underlines how new all this stuff is, really. Widespread retirement, pretty recent. 401k, 1978, Roth IRAs.
1998.
Exactly. We're all kind of figuring this out as we go. So yeah, perceived bad decisions become a lot more understandable.
Which kind of leads into this next big point Housel makes. How much of financial success is actually skill versus how much is just luck or risk? Things outside our control. This part's really fascinating. It's a huge question, isn't it? Because the world's just too messy, too complex for everything to be purely cause and effect based on our actions. Housel argues outcomes are often guided by forces other than individual effort. Look at Bill Gates. His 1 in a million luck was going to Lakeside School. They had this advanced computer when most colleges didn't even have one. Just happened to be there.
Right place, right time. But then there was his friend, Kent Evans. Equally smart, ambitious.
Yeah, shared the same passion.
Yeah.
But he hit 1 in a million risk. Died in a climbing accident before they even finished high school. Same force, sheer chance, but with devastatingly opposite results.
Wow, heavy.
And Housel talks about that thin line between bold and reckless. Figures like Vanderbilt or Rockefeller, they pushed boundaries, broke rules.
Vanderbilt saying, what do I care about the law? Ain't I got the power?
Exactly. Sounds like genius when you succeed. But it could easily have been the words of someone who crashed and burned, right? It's a fine line.
Yeah.
Even Benjamin Graham, the father of value investing, his biggest win, Jaico stock, he admitted it was a lucky break. It broke almost all his own rules about diversification.
So the lesson for you isn't necessarily to try and copy every single move of someone like Buffett, because so much of those extreme successes involves luck you just can't replicate.
Right. It's better to look for the broad patterns, the common themes that are repeatable, rather than chasing those outlier results.
Which brings us to maybe the most powerful force of all, compounding.
Ah, yes, compounding. It's almost counterintuitive, isn't it? How tiny, consistent inputs create massive outputs over time.
He uses that ice age example, right? Not super cold winters, but just slightly cool summers, enough that the snow never fully melted.
Exactly. That tiny difference, repeated year after year, century after century, builds continents of ice. It's the same principle.
And Warren Buffett is the classic financial example.
Totally. Housel argues his real secret isn't just genius stock picks, it's time. Starting investing at age 10 and just sticking with it for, 80 years? 99.9% of his wealth came after age 50. It's the power of that base, compounding for decades and decades. Think about hard drive space, megabytes to terabytes.
Yeah.
Nobody predicted that scale of growth.
So the practical takeaway from her is maybe don't chase the absolute highest returns, because those are hard to sustain.
Right. It's about getting pretty good returns that you can stick with for the longest period of time. That consistency over years, that's where the real magic happens.
Okay, let's shift gears. There's this dangerous trap Housel talks about, even for really successful people. Always wanting more. When is enough, actually?
Enough. What's a deep one? Why risk everything you have, everything you actually need, for something you don't have and don't need? It really pushes back on the idea that more money automatically means more happiness. You see in stories like Rajat Gupta, former head of McKinsey, worth over $100 million.
Yeah.
Legitimately. But he wanted more. Wanted to be a billionaire. Got caught up in insider trading, prison, reputation ruined. Just threw it all away.
And Bernie Madoff had a successful legal business making millions. But it wasn't enough. Built the biggest Ponzi scheme ever. Lost everything. For what?
It's that inability to define enough. Housel mentions that great story about Joseph Heller, the author of Catch-22. At a party hosted by a billionaire.
Oh, yeah, the Kurt Vonnegut right.
Yeah.
The billionaire made more money in a day than Heller made from Catch-22 ever.
Aye. And Heller's response was, yes, but I have something he will never have. Enough. Profound.
So the hardest skill, Housel says, is getting the goalpost to stop moving.
Exactly. If you keep raising your expectations as your income rises, you never feel like you're getting ahead. You just keep taking more risks. And social comparison is brutal. Housel uses the Mike Trout example. Makes $36 million a year, but maybe compares himself to a hedge fund guy making $340 million, who compares himself to Bezos. It's a game you just can't win.
So enough isn't settling for too little. It's realizing that always chasing more eventually leads to regret. You got to know when to stop.
And he lists those crucial things that are never worth risking. Reputation, freedom, family, friends, being loved, happiness. That list really puts financial risk in perspective, doesn't it?
Absolutely. Okay, so say you've built some wealth. How do you keep it? Housel says getting rich and staying rich are totally different ballgames.
It's such a key distinction because, sticking around long enough often matters more than short-term growth spurts or being brilliant. Survival should be the bedrock of your strategy. Think about Jesse Livermore, the famous trader. Made fortunes, lost fortunes multiple times. Ended tragically. Or Abraham Jermansky, the developer, wiped out in 29. They were great at getting rich.
But terrible at staying rich.
Precisely. Contrast that with Michael Moritz at Sequoia Capital. Decades of success. His reason, always being afraid of going out of business. That paranoia, that focus on survival.
And Buffett, too, right? It's as much about what he didn't do. Didn't load up on debt, didn't panic sell, didn't ruin his reputation, didn't stick rigidly to one thing. He just survived, endured.
So applying that survival mindset means aiming to be financially unbreakable. Housel talks about holding cash, even when markets are roaring. It's not about missing out on returns.
It's insurance. Insurance against having to sell stocks at the worst possible time, like in a crash.
Exactly. Good returns, sustained without interruption, always win long term. And you have to plan on the plan not going according to plan. Because life throws curveballs. 9/11, recessions, pandemics, stuff happens.
Which leads to needing room for error. Margin of safety. It's not just being cautious, is it?
No, it's about actively increasing your odds of survival. Like blackjack players who count cards but never bet their whole stack on one hand. They build in resilience. Benjamin Graham said the point of margin of safety is to make forecasting unnecessary. You need that barbell personality Housel mentioned.
Optimistic about the long term, but paranoid about the short-term threats.
Yes, you need both. Because growth happens amidst destruction, right? Like the brain pruning synapses or the economy growing despite wars and crashes. You got to survive the bad times to benefit from the good.
And avoiding single points of failure, like the mice taking out German tanks. You can't predict everything.
Right. And the biggest single point of failure for most people, just relying on a paycheck with no savings buffer.
Mm-hmm.
Building resilience lets you stay in the game long enough for the odds to work in your favor.
Okay, let's dig into something really personal. Household covers. The fact that you change over time. How does that mess with long-term financial planning?
It's a huge factor. Psychologists call it the end of history illusion. We tend to think we've basically become the person we'll always be, but we drastically underestimate how much our desires, goals, even personality will shift.
Hmm.
So how do you make plans for 30, 40 years from now when the you of the future might want totally different things? Housel tells that story about his friend who worked so hard to become a doctor.
Yeah, achieved his dream, then realized years later he hated the career. It wore him down.
Or think about your own life goals. What you wanted at 5 versus 15 versus 25. They change.
Tractor driver, lawyer, stay-at-home parent.
Yeah. And then you get hit by sunk costs. You've put so much effort into one path, it feels impossible to change, even if it's not right for you anymore. Future you becomes a prisoner of past you's decisions.
Heavy stuff. Which kind of connects to another idea. Nothing's free, especially investing. What's a price we have to pay? It's not just fees, is it?
Not at all. Housel says the real price of investing success isn't paid in dollars. It's paid in volatility, fear, doubt, uncertainty, and regret. It's an emotional toll. And because that price isn't obvious on a tag, people try to get the returns without paying it. They try to shoplift the market.
Like trying to time the market perfectly or using those tactical funds that promise smoothness but often just underperform.
Exactly. Or look at GE under Jack Welch. They massaged the numbers, tried to hide the bumps, create this illusion of perfect predictability. But eventually, the bill came due. Big losses later on. Same with Fannie Mae and Freddie Mac before the crisis.
So the big mental shift is seeing market ups and downs, not as a fine like you did something wrong, but as an admission fee.
Precisely. Like buying a ticket to Disneyland. You know there will be crowds and long lines, maybe some rain. That's the price of admission for the fun. Market volatility is the fee for potentially higher long-term returns from compounding. You have to be willing to pay it.
And Housel argues that fee is absolutely worth it.
He does. So for you, it's about finding balance throughout life, accepting that fee to build endurance and avoid regret. That acceptance lets compounding work its magic.
Let's zoom out again. What about the hidden narratives? The stories we tell ourselves, the fact that other people are playing different games, how does that shape things?
It's huge. We often assume everyone else is playing the same financial game we are, with the same goals and time frame. But that's rarely true. Housel calls it you and me. He uses the dot-com bubble as an example. For a day trader, maybe buying Yahoo at a crazy price made sense for a quick flip. But for a long-term investor, disaster, different games.
Same with the housing bubble, right? Flippers had one goal, long-term homeowners had another, but they influence each other's behavior.
Definitely. And it happens with spending, too. You see someone you admire driving a fancy car. You might feel pressure to keep up, even if your financial situation or goals are totally different. That lawyer needing the expensive suit versus the writer in sweatpants.
Yeah, that's social pressure. Then there's the seduction of pessimism. Why does bad news always seem smarter?
It's weird, isn't it? Housel notes how predictions of doom always get more attention than optimistic ones. Like that professor predicting the U.S. would collapse, taken seriously. But predicting Japan's post-war boom would have been laughed at, even though it happened. Pessimism often just draws straight lines from current problems, ignoring how people and markets adapt. Like the oil running out prediction that missed fracking.
And progress is slow, setbacks are fast.
Exactly. Airplanes took decades to become common, but one crash is instant news. Heart disease deaths decline slowly over years. One terrorist attack dominates headlines. Pessimism grabs attention.
And when things feel out of control, we cling to appealing fictions, like miracle cures or Madoff's impossible returns. We want to believe.
We do. And Housel warns against the historians as prophets fallacy. History teaches us about human nature, greed, fear, panic, euphoria. Those patterns repeat. But it's not a roadmap for specific future events. Things that have never happened before happen all the time, he says. Think about structural changes like 401ks or venture capital. The past isn't always a perfect guide for the future specifics.
And he wraps that section with a quick history of the U.S. consumer, right? from post-war stability and shared growth to the income divergence and debt-fueled keeping up with the Joneses leading up to '08. It shows how these big forces shape individual behavior.
Yeah, it's a great summary of how these larger narratives impact us all.
So the big takeaway for you is figure out what game you're actually playing. Define your own goals and time frame. And accept that a lot of what happens is just out of your hands. Drop the illusion of control.
Okay, so wrapping this all up, what's the bottom line for your financial life? It really sounds like managing money well is less about complex math and more about understanding ourselves, our behavior.
Absolutely. Which leads to the key question for you. What actually works for you and your family? Because the most important money decisions aren't made on a spreadsheet. They happen around the dinner table. They're driven by your specific goals, things charts can't capture.
Housel leaves us with some really solid, actionable points. I mean, humility and forgiveness really stand out. Knowing luck and risk play a role.
Yeah.
It means you can be kinder to yourself and others when things go wrong or right. It's rarely all skill or all luck.
And less ego, more wealth. That idea that true wealth is the money you don't spend. Resisting that urge for flashy stuff now buys you options later. Freedom. Yeah, and aiming for a strategy that lets you sleep at night. That peace of mind. That's maybe the best benchmark rather than just chasing the highest possible number.
Time. Got to come back to time. It's your biggest ally in investing. Let compounding do the heavy lifting over a long horizon. Patience and endurance.
Be okay with being wrong sometimes. You don't need every investment to be a winner. A few big successes often carry the whole portfolio. Focus on the overall picture.
And maybe the most powerful point. Use money to gain control over your time. That ability to decide what you do when, with who, that's the real dividend money pays. Way more valuable than luxury goods.
So putting it all together, define your game, build in that margin of safety for survival, pay the emotional fee of volatility. It builds resilience.
Right. And accept the messiness. There's no single perfect answer, just what's right for you.
So no one's crazy. The real goal is independence. Waking up and knowing I can do whatever I want today. That's a powerful goal, isn't it? Something really worth thinking about.
It really is. Maybe the final thought for you is this. The greatest financial asset you have isn't your income or your investments. It's your behavior. How are you going to use it to build the life you really want?